that $20,000 is tax-free. Discretionary trust, it is quite simple. It's quite straightforward to own a property in a discretionary trust. What I mean by simple is as compared to an SMSF or as compared to, like, say, a unit trust, where you want to consider this. If you have one family involved, it's a family asset that you want to share amongst your family, where the returns on that investment can be distributed amongst your family, or even the capital gains itself. So there's some ability in tax planning there as well. A discretionary trust, just like an individual or a company, you can access bank funding, you can borrow as a discretionary trust, but you can't use super to fund the purchase itself. And I'll talk, the reason I put in there is because I'm going to run through a self-managed super fund. So when it comes to funding through a discretionary trust, for the deposit, that 30% that Phil mentioned before, roughly, you need to have that cash ready outside a super somewhere to be able to fund part of that property purchase. And to do that is just by lending the discretionary trust some money, and then it can then buy that property through there. Now, the benefit from a tax perspective here, coming back to the slide, is that you can see the trust. It says 0% tax, which is not technically accurate. There's an asterisk there. What it means is you have to treat a trust like a funnel. It actually distributes any profits or income that it makes to its beneficiaries. Now, I mentioned just now, discretionary trust, you can distribute to your family. So you can actually distribute to individuals, but you can also distribute to companies as well. So as you make any profit or capital gain in the trust, you can actually distribute that out. Now, the benefit of that is flexibility, because you can have a little bit of planning, although an individual pays tax all the way up to 47%, sorry, at the top marginal tax rate. The first tax bracket is 0 to close to $20,000. That $20,000 is tax-free. So you can see how you can, with a bit of flexibility, you can plan where your rental income comes through. Now, this plays a big part because your net return on investment, you should always look at after tax net return of investment, not pre-tax, because at the end of the day, you make a return, not all of it is not in your pocket. Some of it goes to the ATO. So if you have a really good investment structure, you can plan for that tax. Hence why there's some ticks here for tax planning. So you can distribute to your family members, or you can distribute to what we call a bucket company. So a bucket company, I should say, pays a flat tax rate. Now, if you run a small business, it pays 25%. Now, if you're just receiving passive trust distribution income, it will be coming through the company itself, and you pay 30% tax. So a trust can distribute to those two. So you can see the flexibility. Again, there's no kind of straight cut answer here, but that's what keeps a discretionary trust simple, is that you can own it in trust, you can have your family have access to it, and you can even build in estate planning considerations, who's going to be controlling those assets if it's a long-term hold as well.